All right, let's talk about iRhythm Technologies, ticker IRTC. Their latest earnings report just hit the street, and wow, did it make some waves. We're going to break down exactly what happened and why the market reacted so strongly.
And this is what I'm talking about. A nearly 18% pop in a single day. I mean, that's a massive move. So the big question is, what on earth did they say to spark a reaction like that? Let's get into it.
So, where does this story begin? Well, it really all comes down to this: a record quarter. And I don't mean just a little bit better than expected. We're talking about a full-on blowout that just shattered expectations. Okay, let's look at the top line first. Wall Street was modeling about 174 million in revenue. Well, iRhythm came in and posted $186.7 million. That's not just a beat. That's a beat by almost $13 million. You can see why that would turn some heads. But here's what's really, really important. It wasn't just about revenue. Look at this. The earnings per share beat expectations by a solid 15 cents. And the profitability? I mean, look at those margins. Adjusted EBITDA margin jumped by 500 basis points. That's a full 5%. Gross margin up too. This tells you they're not just growing, they're growing efficiently. That's called operating leverage, and it's exactly what investors love to see. So you've got to ask, how did they pull this off? Well, the CEO, Quentin Blackford, pretty much handed us the playbook. He pointed to three key things: their core business accelerating, these new channel partners, and their Zio AT product line. These three things are the engine behind this incredible quarter. So let's dig into each one. All right, let's deconstruct this beat. Because if you can get your head around these three growth engines, you'll really understand why people are so excited about this company's future. Okay, so let's tick these off. First, you've got their bread and butter, the long-term monitoring business. It's not just growing, it's accelerating. Second, the Zio AT product, it's really starting to eat up market share. And third, and this one is a really big deal, they're seeing huge success with these new channel partners, which is opening up a whole new world for them. And just look at this. This really puts it into perspective. Almost 70%, 68% of their volume growth came from brand new accounts. Think about that. This isn't just selling more to their old customers. This is rapid, aggressive expansion, grabbing new clients left and right thanks to those new partnerships. So why is that so important? Well, it's about the size of the opportunity here. We're talking about a potential market of 27 million people in the US who have an undiagnosed heart arrhythmia. That is a massive number. They're basically building the channels to go find these patients before something bad happens. Okay, so a great quarter is, well, it's great, but the market always wants to know what's next. It's all about the future. And iRhythm definitely had an answer for that, laying out a really impressive tech pipeline that's all about staying ahead of the competition. And this partnership with Lucem Health is a perfect example. This is a real game changer. Think about it. Instead of waiting for a patient to show up with symptoms, reactive care, they're using AI to proactively find high-risk people before they have a cardiac event. And get this, the pilot programs are finding the right people 80 to 90% of the time. That is just incredible. And it's not just about AI and software. They've got new hardware coming too. This next-gen device, the Zoom CT, is a big deal. It's going to be smaller, way more comfortable, it'll last longer, up to 21 days, and it has better reporting. This is basically their weapon to go after an even bigger slice of the mobile cardiac telemetry market. And one more thing on the tech front, they're making it easier for doctors to actually use their stuff. By integrating directly into Epic, the biggest electronic health record system out there, they're removing friction. And what happens? Doctors use it more. We're talking a 20+% increase in prescriptions at some places. That's a huge lever for growth, and it makes their customers incredibly loyal. So let's just recap for a second. You have a record-breaking quarter, you have multiple growth drivers firing on all cylinders, and you have a tech pipeline that looks fantastic. What do you do if you're management? You raise the bar for the rest of the year, and that's exactly what they did. And we're not talking about a small, cautious bump here. They jacked up their full-year revenue guidance by $30 million. That's a huge vote of confidence. It tells you they believe this momentum is real and it's here to stay. And on top of that, they're guiding to even better profitability for the year. It's the whole package. They also gave us a few other key things to think about. First, they said Q3 might be a tiny bit lower than Q2, but that's just normal summer seasonality, nothing to worry about. Second, They basically promised to be free cash flow positive for the full year 2026. That's a huge milestone. And third, the cherry on top, the early read on Medicare payments for next year looks good, so the reimbursement picture looks stable to positive. So you add it all up, the huge beat, the growth engines, the pipeline, the raised guidance, it's a pretty compelling story. Now let's get to our take on all this. So after a report like that, the big question on everyone's mind is, what happens now? Can they keep this amazing momentum going? Where does the stock go from here? All right, here's our prediction. First, for the next quarter, we think they're going to beat expectations again. That guidance for a slight dip just feels a bit too conservative, especially with all the momentum they're carrying. For the stock itself, we expect it to digest this big move up, build a nice solid base, and then start heading towards new highs after the next report. All things considered, we're initiating a 12-month price target of $210. Look, the bottom line is this was a statement quarter. It marked a real turning point for both their growth and their profitability. The strategy is working, simple as that. And for that reason, we are rating the stock outperform. And as always, please remember, this is not financial advice.